I'm Joseph, and this is Wise Life America. Patricia had been a high school math teacher in Arizona for 32 years. She was 61 years old. She had a $480,000 traditional IRA, a modest pension coming in retirement, and 4 years until she planned to stop working. She thought she had plenty of time. She was thinking about Social Security, about Medicare, about when to stop contributing to her IRA and start drawing from it. What nobody had told Patricia was that 61 is not just another year on the way to retirement. It is the most important tax year of her entire retirement. And she was spending it the same way most people do, waiting. By the time Patricia sat down with a retirement tax specialist at 63, 2 years had already passed. The specialist ran the numbers and showed her what those 2 years cost her. Because she had not done a single Roth conversion at 61 or 62, she had missed the lowest bracket window she would ever have again. Her Medicare premium at 65 was going to be higher because of income she had recognized at 63 that she could have avoided. And her IRA was now larger, which meant her required minimum distributions starting at 73 would be larger too, pushing her into a higher bracket for the rest of her life. 2 years of waiting, one lifetime of consequence. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Joseph. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. What I'm going to do in this video is explain exactly why 61 is different from every other age in your retirement timeline, what specific actions are available at 61 that become dramatically harder at 62, 63, and beyond, and what the dollar cost of waiting actually looks like in real numbers. Let us start with why 61 is different. Most people think of retirement milestones as specific ages where something changes. 59 and 1-2 is when penalty-free IRA withdrawals begin. 62 is when Social Security eligibility opens. 63 is when the Medicare ERMEAA look-back window becomes relevant. 65 is when Medicare begins. 73 is when required minimum distributions start. Every one of those ages has something attached to it. A rule that kicks in, a benefit that opens, a system that starts watching. 61 has none of those things attached to it, and that is exactly what makes it powerful. At 61, Social Security is not yet available, which means it is not yet a factor in any of your income calculations. At 61, the ERME 2-year look-back has not yet opened, which means income you recognize today will not affect your Medicare premiums when you enroll at 65. At 61, required minimum distributions are still 12 years away, which means you have full control over how much you withdraw and when. No one is forcing your hand. No system is telling you what to do. At 61, you are in the last year of complete financial silence, and most people spend it doing nothing. Here's the first thing you need to understand about that silence. In retirement planning, the most powerful moves are the ones you make by choice, not the ones you make by requirement. The IRS is very good at creating requirements. It is not good at reminding you about the opportunities that exist before those requirements begin. 61 is a year of pure opportunity. It is the last year before the three major retirement income systems, Social Security, ERMEA, and RMDs, begin overlapping and interfering with each other. And the retirees who understand this use 61 aggressively. The ones who do not spend their retirement reacting to decisions they did not realize they were making. Now let me show you exactly what changes at 62, 63, and beyond so you understand what you are protecting when you act at 61. At 62, Social Security eligibility begins. This does not mean you have to claim it. Most people should not claim at 62, but the moment you are eligible, Social Security enters every income planning conversation you have for the rest of your life. Here is why this matters even if you do not claim. The IRS uses a formula called provisional income to determine how much of your Social Security benefit becomes taxable. The formula takes your adjusted gross income, adds any tax-exempt interest, and adds 50% of your annual Social Security benefit. That total is your provisional income. At 62 and beyond, even if you have not claimed Social Security yet, every financial decision you make gets filtered through the question of how it will interact with your future Social Security income. A Roth conversion that would have been clean and simple at 61 now requires you to model its interaction with your projected Social Security benefit, your expected claiming age, and the provisional income formula. The math does not get easier, it gets layered. At 63, Medicare enters the picture in a specific and very expensive way. IRMA, the income-related monthly adjustment amount, is a surcharge the federal government adds to Medicare Part B and Part D premiums when your income exceeds certain thresholds. The surcharge is based on your income from 2 years earlier. Your income at 63 determines your Medicare premium at 65. Your income at 64 determines your Medicare premium at 66. The 2026 ERMAA threshold for single filers is $109,000 of modified adjusted gross income. For married couples filing jointly, it is $218,000. Crossing that threshold by even $1 triggers a full surcharge at that tier. For a married couple where both spouses are on Medicare, the first IRMA tier adds approximately $948 per year in additional Part B premiums alone, before any Part D surcharges. At the highest IRMA A tier, the monthly Part B premium reaches $689.90 per person per month. Now, here's the connection to 61 that most people never make. A Roth conversion you do at 61 has zero IRMA A impact. Zero. The income you recognize at 61 does not affect your Medicare premium because the 2-year look-back does not start mattering until you are approaching 65. That same conversion done at 63 could add thousands of dollars per year to your Medicare premiums for the next 2 years. Same conversion, same dollar amount. Completely different lifetime costs depending solely on which age you do it. This is why 61 is not just another birthday. It is the last year the IRS cannot charge you a Medicare penalty for aggressively managing your tax situation. Now, let me explain the 4 strategies that are available at 61 and become dramatically harder or impossible to do cleanly at 63 and beyond. Strategy 1 is Roth conversions at the 12% bracket. The 2026 tax brackets confirmed on irs.gov through Revenue Procedure 2025-32 are as follows. The 12% bracket applies to taxable income between $12,400 and $50,400 for single filers, and between $24,800 and $100,800 for married couples filing jointly. The standard deduction in 2026 is $1,600 for single filers and $3,200 for married couples filing jointly. This means a single filer with zero other income can convert up to $66,500 from a traditional IRA to a Roth IRA and pay only 12% federal tax on the entire converted amount. A married couple with zero other income can convert up to $133,000 and stay entirely within the 12% bracket. The 12% to 22% jump is the single largest percentage point gap in the entire federal tax bracket structure. It is a 10 percentage point cliff. On a $50,000 conversion, the difference between 12% and 22% is $5,000 in additional federal taxes. Over 10 years of conversions, that gap compounds into $50,000 or more. At 61, with no Social Security income, no pension yet if you have not retired, and no RMDs for more than a decade, your taxable income may be at its lowest point in your entire adult life. The bracket space available to you at 61 may never be this wide again. Every year you wait past 61, your bracket space gets tighter. Social Security income comes in, pension income arrives. RMDs begin at 73 and they are mandatory. By the time most retirees realize they should be doing Roth conversions, the bracket space that existed at 61 is mostly gone. Strategy 2 is the 0% long-term capital gains rate. In 2026, long-term capital gains are taxed at 0% for taxable income up to $4,950 for single filers and $98,900 for married couples filing jointly. These thresholds are calculated after your standard deduction. This means a married couple at 61 with $100,000 in a taxable brokerage account that has appreciated significantly can sell and harvest those gains at 0% federal tax. provided their total taxable income, including the gain, stays below $98,900. Here is a real example of what this looks like. Thomas and Carol, the couple from Tennessee we will meet in detail later in this video, have a taxable brokerage account they built over 30 years of investing. They bought index funds in 2001 for $20,000. Those funds are now worth $95,000. They have an unrealized gain of $75,000. If they sell those funds in a year when their taxable income is below $98,900, the entire $75,000 gain is taxed at 0% federal rate. 0% on $75,000 of gains. That is a tax bill they would have paid in any working year, easily $15,000 or more, reduced to nothing because they manage their income below the threshold at 61. But here is the strategic move that makes this even more powerful. After harvesting the gain at 0%, they can immediately reinvest in similar or identical assets, establishing a new cost basis at $95,000 instead of $20,000. Every future dollar of gain on those assets now starts from the higher basis. They have permanently reduced the taxable gain on those assets for any future sale without triggering a wash sale violation, because the 0% harvest was a complete exit and re-entry, not a loss harvest. If you are doing Roth conversions at the same time, you need to coordinate carefully because every dollar of conversion raises your AGI and reduces the room available for 0% capital gains. But at 61, you have maximum flexibility to run this coordination because no other income systems are interfering. At 63, a large capital gain or Roth conversion can push your income over the IRS threshold, adding nearly $2,000 in Medicare surcharges per couple on top of the tax itself. At 61, the shadow cost does not exist. Strategy 3 is ACA Marketplace Health Insurance Subsidy Optimization. If you are 61 and retired or semi-retired and not yet on Medicare, you are in a 4-year window where your income level determines your access to subsidized health insurance through the ACA Marketplace. In 2026, the enhanced ACA subsidies that had been available since 2021 have expired. The subsidy cliff is back. To qualify for premium tax credits in 2026, your household income must be between 100% and 400% of the federal poverty level. For a single person, 400% of the federal poverty level in 2026 is approximately $60,240. For a married couple of two, it is approximately $81,860. This means that at 61, if you're managing your income to stay below the 400% threshold, you may qualify for meaningful premium tax credits on ACA Marketplace health insurance for up to 4 years before Medicare begins. The dollar value of those credits varies significantly by age, location, and plan choice. But at age 61, premiums for unsubsidized coverage can run several hundred to over $1,000 per month per person, making subsidy eligibility financially significant. The critical interaction is this. Every dollar of Roth conversion income counts toward your MAGI for ACA subsidy purposes. So at 61, you're managing a 3-way coordination. Roth conversion income, capital gains harvesting, and ACA subsidy income management. This is complex but entirely doable at 61 when none of the other retirement systems are interfering. At 65, Medicare replaces ACA coverage entirely. At 63, income you recognize can simultaneously affect them 2 years later and ACA subsidies today. At 61, you can coordinate all 3 of these against each other cleanly with full visibility. Strategy 4 is proactive income floor planning for the next 30 years. This is the strategy most people completely miss, and it is the one with the largest long-term dollar impact. Here's how to think about it. Every dollar sitting in your traditional IRA today is a dollar that will eventually be forced out as a required minimum distribution, starting at age 73. Your RMD is calculated by dividing your prior year account balance by a life expectancy factor from IRS tables. At age 73, the uniform lifetime table factor is 26.5. So if you have $500,000 in your traditional IRA when you turn 73, your first RMD is approximately $18,968. But here's what makes this a 30-year problem, not a 1-year problem. If your account grows between 61 and 73, the RMD will be larger. If the factor shrinks as you age, which it does, the RMD percentage increases each year. At age 80, the factor drops to 20.2. If your account has grown to $700,000 by then, your annual RMD is approximately 34,053. That mandatory distribution stacks on top of your Social Security, on top of your pension, and pushes a larger and larger portion of your income into taxable territory every year. The retirees who arrive at age 73 with large unconverted traditional IRAs have no flexibility. The RMDs come out whether they need the money or not. The income is taxable at ordinary income rates. If the RMDs push their total income above the Social Security provisional income thresholds of $34,000 single or $44,000 for married couples filing jointly, up to 85% of their Social Security benefit becomes taxable on top of the RMD. Every dollar you convert from your traditional IRA at 61 reduces the balance that will be subject to mandatory distributions at 73. Every dollar that goes into your Roth at 61 grows tax-free and is never subject to required minimum distributions during your lifetime. Roth IRAs have no lifetime RMD requirement. The math is straightforward. A dollar converted at 61 at 12% federal tax costs 12 cents. That same dollar left in the traditional IRA, forced out as an RMD at age 76 at a 22% effective rate, costs 22 cents. On $100,000 of conversions over the next several years, the difference is $10,000 in federal taxes. But the actual long-term impact is larger because the converted dollars in the Roth grow tax-free for the next 30 years, compounding, without future tax drag. Let me make this even more concrete with the full 20-year projection. Patricia from the opening story has $480,000 in her traditional IRA at age 61. If she does nothing and her IRA grows at 7% per year until age 73, her balance at 73 will be approximately $1,027,000. Her first RMD at age 73, using the IRS Uniform Lifetime Table Factor of 26.5, will be approximately $38,800. The $38,800 RMD stacks on top of her pension of $12,000 per year and her Social Security of approximately $22,000 per year when she claims at age 70. Her total income in year one of RMDs is approximately $72,800. Her provisional income is her AGI of $70,800 plus 50% of Social Security, which is $11,000. That is $83,800 of provisional income, which is well above the $34,000 single filer threshold for 85% Social Security taxability. At 85%, $17,000 of her $22,000 Social Security benefit is taxable. She is paying ordinary income tax on her RMD, on most of her Social Security, and on her pension. Her total federal tax bill in the first year of RMDs is approximately $12,000 to $14,000 on income she may not even need. Now look at what happens if she converts $80,000 per year from age 61 through 64. A 4-year window totaling $320,000 converted. Her traditional IRA balance at 61 drops by $80,000 per year over 4 years. By 65, she has converted $320,000, and her remaining traditional IRA balance, growing at 7% during the 4 years, is approximately $300,000 instead of $700,000. At age 73, that remaining $300,000 balance has grown to approximately $640,000, assuming the same 7% return. Her first RMD is now approximately $24,150 instead of $38,800. Her total income is lower. A smaller portion of her Social Security crosses into the 85% taxability threshold. Her lifetime federal tax bill is materially lower, and her Roth IRA, which received $320,000 in conversion starting at age 61, has grown to approximately $800,000 at age 73 at 7% annual returns. Every dollar of that $800,000 is permanently tax-free. No RMDs, no tax on withdrawal, no IRMA impact. The retirees who plan aggressively at 61 do not just save money in the near term. They design an income floor that gives them flexibility for the next 3 decades. The ones who wait spend those decades reacting to a system that is telling them what to do instead of the other way around. Now let me bring this together with a real scenario so the numbers become concrete. Thomas is 61 years old. He retired early from a manufacturing company in Tennessee at age 60. His wife, Carol, is also 61 and recently stopped working. Together, they have $700,000 in traditional IRAs split between them. They have no Social Security yet, no pension, and they are living on savings and a small amount of dividend income from a taxable brokerage account. Their total taxable income in 2026 before any Roth conversion is approximately $18,000. After their $32,200 standard deduction, their taxable income before any conversion is zero. They have bracket space. Thomas and Carol decide to convert $100,000 from their traditional IRAs to Roth IRAs in 2026. Their total taxable income is now $100,000. They owe approximately $9,000 in federal income tax on the conversion at an effective rate well below 12% because the bottom of the income is covered by the 10% bracket and the standard deduction. That $9,000 tax bill today is buying them permanent tax-free growth on $100,000. At a 7% average annual return over 12 years until RMDs begin, that $100,000 becomes approximately $225,000 inside the Roth, completely tax-free. Their traditional IRA balance is now $600,000 instead of $700,000, which means their future RMDs will be proportionally smaller. They also stay well below the IRMAA threshold because their converted income is $100,000, which is $100,000 below the $218,000 joint IRMAA threshold. Zero Medicare surcharge impact. And because they are not yet 63, the income they recognized at 61 has no IRMAA look-back consequence at all. Now here's what happens if Thomas and Carol wait until 63 to do the same conversion. The income recognized at 63 becomes the basis for their Medicare premium at 65. If they convert the same $100,000 at 63, their MAGI for that year is approximately $118,000, including other income. That is above the $109,000 single filer ERMA threshold, but we are looking at a joint scenario where the threshold is $218,000. In this case, they stay below the joint ERMA threshold, but if either of them has additional income from a pension or other source, or if they need to do a larger conversion to make up for the 2 years they waited, they risk crossing that threshold and triggering a 2-year Medicare penalty. 2 years of waiting also means 2 years of additional growth inside the traditional IRA at pre-tax rates, which makes the balance larger, which makes future RMDs larger, which makes the problem harder to solve. Every year of delay does not just push the problem forward, it makes it bigger. Before we continue, if you are still watching right now, it tells me you understand that the moves that actually change your retirement outcome are the ones you make before the system starts making them for you. That is exactly who this channel is built for. Hit the like button. It helps this reach the people who need it, and subscribe if you have not already so you never miss a video like this. Let us talk about what happens to the people who miss this window entirely. The most common path is this. A person turns 61, they're still working, or they recently retired. They feel no urgency because nothing external is demanding their attention. No letter from the IRS, no required action, no penalty for ignoring 61. So they wait. Now, let me be specific about the 3 most predictable mistakes that follow when someone misses this window, because they are not random. They follow a pattern. The first mistake is doing Roth conversions too late and too large. When retirees finally realize they should be converting, they often try to compensate for lost years by doing a very large conversion in a single year. A couple who waited until 65 to start converting might try to convert $300,000 in 1 year to make up for the 4 years they did not convert. That single $300,000 conversion generates $300,000 of additional income in 1 calendar year. It pushes them into the 22% to 24% bracket. It pushes their MAGI well above the IRMA threshold, triggering a Medicare surcharge for the next 2 years. It potentially makes 85% of their Social Security taxable if they are already claiming. The conversion that should have been spread across 4 or 5 years at 12% gets compressed into 1 year at a much higher blended rate, and then triggers Medicare penalties on top of that. The cost of catching up is always higher than the cost of planning ahead. The second mistake is discovering the RMD problem at 73. A retiree arrives at 73 with $800,000 or $1 million in a traditional IRA. They have been told their whole life to maximize pre-tax contributions. They did everything they were told. Now, the IRS is forcing them to withdraw $50,000 or more per year whether they need it or not, and every dollar is taxed at ordinary income rates. At this point, the options are limited. They can do Roth conversions on top of the RMD, but the RMD itself uses up most of their low bracket space. They can use qualified charitable distributions to offset up to $111,000 of RMD income per year if they have charitable intent. They cannot undo the compounding that made the problem larger. The retiree who converted aggressively at 61 does not have this problem. Their traditional IRA is smaller. Their RMDs are manageable. They are not reacting. The third mistake is failing to model the surviving spouse scenario. At 61, both spouses are alive and planning together. When one spouse dies, the survivor must file as a single filer starting the following tax year. The IRMAA threshold drops from $218,000 to $109,000. The Social Security taxability threshold drops from $44,000 to $34,000. If the couple's income was designed around joint thresholds, the surviving spouse is suddenly dramatically overexposed. A Roth conversion strategy built at 61 that accounts for the survivor scenario will look materially different from one that ignores it. This planning can only be done cleanly when both spouses are alive and income is low. At 61, that window is open. The most common path is this. A person turns 61, they are still working, or they recently retired. They feel no urgency because nothing external is demanding their attention. No letter from the IRS, no required action, no penalty for ignoring 61. So they wait. At 62, Social Security eligibility opens. They start thinking about when to claim. Every income planning conversation now includes a Social Security modeling question. At 63, they do a large Roth conversion because someone finally told them they should. But the income from that conversion is now on their 2023 tax return, which the Social Security Administration and Medicare will look at in 2025 when they enroll in Medicare at 65. IRMAA hits. They pay more for the same coverage. At 65, Medicare begins, and they are on a premium determined by income they had no idea would matter. At 73, RMDs begin. Their traditional IRA is larger than it would have been because they never reduced it during the low-income years. The RMDs push them into a higher bracket. Social Security is now 85% taxable because their provisional income is well above the threshold. Every one of these outcomes is the direct result of decisions not made at 61. None of them are dramatic in isolation, but together they represent tens of thousands of dollars over a 20 to 30-year retirement that could have been kept and used by the retiree instead of paid to the IRS. The emotional dimension of this is something that never appears on a tax form. When you spend your working years accumulating wealth, you feel in control. The numbers go up. You're building something. Retirement changes that dynamic. You are drawing down instead of building up. If you have not set up your income structure proactively, every withdrawal feels uncertain. Every tax bill feels like a surprise. You're constantly wondering if you are doing it right. The retirees who planned at 61 feel different. They know why they have been withdrawing what they are withdrawing. They know their Roth balance is growing tax-free. They know their RMDs will be manageable because they reduce the account that drives them. They know their Medicare premium is the standard rate because they managed income strategically in the years before enrollment. That sense of control is not just financial. It changes how retirement actually feels. Let me give you the specific action checklist for this video. These are the 6 things you should do this year if you are 61. Action 1.